Us now to discuss is Brett Sifling, Gerber Kawasaki Director of Get Invested. Welcome, Brett.
Thanks for having me.
Thank you for being on. So the Federal Reserve, the minutes just came out. They think that there'll be smaller interest rate hikes, Fed funds rate hikes in the upcoming meetings. What do you think is the true impact on Bitcoin? We're seeing it go back down to where it was prior to the release of the notes.
It's very clear that as the federal fund rates keep going higher and general yields around the world keep getting higher, that it's sucking a lot of the speculative money out of digital assets like Bitcoin and even the US equity markets as well, because investors are less willing to take on this speculative risk if they can earn meaningful yield from other assets. And so it's just another global headwind that is kind of facing Bitcoin right now. Not to mention everything else that's going on.
Right. So basically what you're saying is that just even the small amount of interest rate increases, we're looking at the 10-year yields close to, was it like 3 3/4, close to 4%, that's just enough to basically take out that speculative money away from crypto, which already the base prices are going down. They're not seeing any yields. They're finding it tough to earn anything out of it. And they're willing to say, you know what, it's too much risk for me. Do you think that will change anytime soon? Or do you think that crypto is going to be plagued with higher rates because of higher rates in the months and years to come?
We'll see. It's very, very hard to predict rates. I mean, if you asked anyone at the beginning of this year that they thought that we were going to have this historic rate cycle, I think almost no one guessed it. And it's going to be one to watch. I mean, the Fed meetings that are coming out month after month and the inflation reports are something that we're watching very, very closely. This last inflation report, we had hints of it slowing down, and we do think that they're facing easier comps as we get into December, January, and February. So if that trend does continue and the Fed decides to take their foot off the pedal, basically, then yeah, it could be a better environment for Bitcoin and just digital assets next year as more liquidity would creep back into the system.
Now, of course, that's assuming all things being equal. Unfortunately, all things are not equal. As you alluded to before, we did have this issue. Of course, we've had several crises, one after another, it seems, in crypto, starting with Terra Luna, Three Arrows Capital folding. It goes on and on and on, all the way now to FTX, and then potentially others. People are looking at Genesis, et cetera. Genesis, of course, being a sister company to CoinDesk, both owned by DCG. What do you think will ultimately, do you think that part of the equation is going to continue being a problem, a bigger headwind, if you will, compared to monetary policy?
I think that it definitely has equal weight, at least, because what we're seeing is a structural problem in the infrastructure of digital assets, right? When you start seeing brokers or lenders going down in a space, you're kind of thinking about other great financial collapses of 2008, where there was basically buildups in the system that had to be diversified away. And ultimately, that's exactly what's happening in crypto right now, is that these over-leveraged firms have been taking on a significant amount of risk, and it's spilling over into other parts of the industry. And we don't know really how deep this goes yet. We don't know what the unwinding of these companies is going to do. And that's why we're big proponents in our own crypto program to pull those funds off of exchanges into your own cold storage so that you have access to that crypto asset, and it's not just an IOU from an intermediary.
So now you mentioned telling your clients to put their assets into cold storage, into hard wallets, potentially, I assume. But are you telling them to buy more, or do you think that they should sit on the sidelines and wait to see where things fall?
Every person is different. So we build financial plans here at my firm, and we keep crypto as an allocation of, let's say, less than 5% of their total assets. Someone who's young like myself and has a long time horizon and we're looking for growth in our portfolio, yeah, I think that it's a great opportunity to be dollar cost averaging down here and picking up little bits around the way. And it's a great way to take advantage of the volatility. But if you're someone who is maybe older looking at retirement and you can't take on these risks, then digital assets just aren't for you. You know, a lot of people kind of get wrapped up in the hype that we've seen over the past, couple cycles, and they want to get on board. But ultimately, the truth is that crypto assets aren't generally right for every single person. And you really have to know your situation, know the appropriate asset allocation, and really have some sound advice along the way if you're actually going to be buying these things.
So basically, it's age and risk aversion are the two things, of course, that you're looking at here. Of course, the two things being tied together. Nonetheless, do you have any short-term views, or when I say short terms, within the next 6 months, for instance, are you generally feeling a little bit, even to those who are willing to take risks and maybe doing DCA, dollar cost averaging, are you telling them, you know what? It could actually, it could go lower here. Give it a little bit. Or are you saying, no, this is it. We've bottomed.
It's very hard to predict the price of assets, especially one like Bitcoin, which doesn't necessarily have an intrinsic value that you can ultimately build a DCF model or any other model around, right? And so over the next 6 months, it's going to be very volatile as we continue to work out these macro headwinds. And we also have to realize that over 51% of the total wallets, or the total Bitcoin wallets, are actually underwater on those Bitcoin investments. So as we get closer to the end of the year here, we're looking at a generational tax loss harvesting opportunity. Yeah. And there's no wash sale rule in crypto, like as of right now, like there is in the stock market. And so we might see a lot more downward pressure as people take their losses towards the end of the year and ultimately get their taxes in line for 2022 and then reset for 2023.
So, of course, I know you might not, just real quick before we go, are you asking people are you telling your clients that, hey, now's the time to do the tax loss harvesting? We're almost at December already. It doesn't, if they bought over in like when it was at 50 or 60,000, now's the time to take that loss. Are you telling them to do that and just wait until next year? Or are you saying hodl a little more? You might,
In most incidents, it makes sense to take the loss and realize that loss and then ultimately redeploy the capital again, because you don't have that wash sale rule like you do with equities. And so it's smart to lock that in for this tax year and kind of reset for next year. Again, every situation's different, so you definitely want to consult a professional.
Well, as somebody who's risk averse and probably in the older age range, according to AARP, who just sent me a letter today, I might have to take some of those tax losses. Thank you very much, Brett Sifling. He's Gerber Kawasaki, director of Get Invested.